Good morning and welcome. Welcome to the 36th Annual College of Business Technology Outlet Conference.
We have time for some questions from the audience. You should come up here, Moses. You look like a...
Thank you. Well, I'd like to thank all the panelists and Mr. Sarver especially, and Mrs. Sarver for coming up. I have a question for Elliot and then some of the other panelists as well. Most of the comparisons to our positive economy that we're trying to recover to are from 2007. But as we all know, that economy was based on a false foundation. Wall Street failed in 2008 because we were betting on mortgages that had nothing behind them. And housing prices, had gone up really high all over the country, here in Arizona as well. But those prices are not sustainable because, again, they were built on a false foundation. So I'm wondering why we keep aiming for a false economy.
Well, no, we're comparing with, if you take a look at those charts, we're comparing the first 3 years of recovery to the last six recoveries. Okay? And as Dennis pointed out, historically, the worse the fall, the bigger the rebound, which is why the rebound after the 80 and then 81, 82 recessions is so great, so severe. This hasn't happened. So we're talking about mediocre growth in a period where historically you would have expected more rapid growth. There were simply structural problems. So I think no matter how you cut it, the economy is improving but weak, and there's a lot of reasons for it, but we're not comparing to just 2007. We're comparing to what you would expect normally out of the type of decline we had.
I'd also add that 2007 is still a meaningful benchmark because you have essentially full employment. Exactly what the mix of employment and production is the question I think that you're getting to. We don't need the same size of a housing sector as we have been because of those kinds of issues. So we're still shooting for full employment. 2007 still represents that in the aggregate, but the actual composition of what people are doing presumably will be different and hopefully more sustainable.
Agreed. Actually, I'm not an economist, but I'm going to thank her, so I'll give a little insight to that. I think your question actually gets at something that's very important going forward, and that's that Arizona will be well off to try to build a more well-rounded economy than we have had in the past. We've been very cyclical. Housing is a big part of it. Housing is going to be a big part of it, and construction is going to come back. But to the extent that your question, acknowledges that much of that job decline from the peak in 07 came in the construction sector, it does, point to a danger for us in the next generation if we can't figure out from a local and state government perspective how to create policies that make our economy, a little bit more well-rounded. So, if that's what your question was getting at, I think it was a pretty good question.
Thank you very much. It's, I guess, this new normal that they talk about. If 2007, was an aberration, that's not the normal that we want to get back to. It's new normal. So I appreciate all your comments. Thank you.
Other questions?
Sorry. Again, thanks for the presentation. Always an important part of our planning at the City of Flagstaff. My question was about tourism. That was one of the industries in Mr. Pollack's area that I didn't see as much on there. And I also would be interested, so one, kind of what's your forecasting in the tourism sector, but also what do you think of kind of the hypothesis that if there's a lot of uncertainty and people are sitting on their money, are they willing to spend more of it on tourism because it's a shorter, smaller expenditure than some of the other things?
We'll let Ron address most of that, but the bottom line is that the employment statistics show that leisure and hospitality is up, and for the state as a whole, and it's up at a pretty good clip. So something's right. I can't quite reconcile it with the occupancy data, quite frankly, but appears to be an increase in employment in that sector. So there's some improvement, but that sector too is improving at a very slow rate.
Yes, as I mentioned earlier in my presentation as well, I mean, the numbers are showing some increases, but they're always going to be tempered by people thinking, what is it that I should spend my money for? And when we're feeling good about ourselves and when we've got the extra money, it goes toward things like tourism. People will take longer vacations, they'll go further away, they'll spend more when they're there, they'll do the right things with respect to getting more money in circulation. But because of the 5 years now almost of having a rather depressed economy, when you've got to think about, well, what can I give up? I mean, it's not going to be my food, my clothing, or my children's education. It's going to be the discretionary income that's often associated with the tourism. So for that reason, I'm thinking that in general, we've got to get more people thinking, and we've got to see the results that are moving in the right direction before it's really going to take off. But again, all the underlying fundamentals seem to be in the right place to suggest that we're going to be doing a little better in the next year and maybe the following year than what we were, say, particularly in 2009 when things were not well in that sector.
Other questions? Back in the back, and then we'll get you.
I'll direct this toward Mr. Pollock. We hear so much about the fiscal cliff and that something has to be done. What, in your opinion, should we do or should the government do about the fiscal cliff?
Well, I think I had it up there. In essence, there has to be some compromise. You're going to have tax increases, and essentially, people who say there's not going to be a tax increase, they're just not looking at the numbers. There has to be. Although you can't get a 50% increase in revenues to the government out of taxes. So you have to actually address things like Social Security and Medicare. Social Security, I believe, was 1933 or 34 when it passed. The average life expectancy was 63 years old. So if you're going to retire at 65, who cares? Most people, more than half will be here. But it's now the average life expectancy is what, about 78? And the retirement age has gone up 2 years. It doesn't work. Same thing with Medicare. If you take a look at medical costs, the difference between the U.S. and the rest of the world is how much we spend on people over 65. And the sad reality is that's going to have to change. My opinion is that you're going to have to deal with those issues, and you're going to have tax increases, and you're going to have to somehow structure the tax increases so there's not a big disincentive on business, and you have to phase it in over a period of time, because you had it in a short period of time. The negative effect on the economy would be too great. We'd be back in recession.
Something like Simpson Bowles, they're going to work on a big deal. They're going to try to get a big deal done. Something like Simpson Bowles, I think you're going to see that happen, hopefully.
I would say that one of the observations is that the fiscal cliff is here because last year nobody wanted to make those political decisions. So how are they going to solve this? Well, they're going to postpone it again. So they're pretty good at kicking the can down the road. The road keeps appearing. So I think what's going to happen is that all this fear and loathing is going to kind of dissipate. Probably we'll end up with $1.5 trillion of additional debt that will cover everything, and then people will say, well, we'll really work on this next year. And that's kind of the nature of the political beast there. In terms of actually solving the problem, I don't think we're ever going to get anywhere close to it. I mean, as Elliot was sort of mentioning, we need to overhaul all these social programs, and I really don't see the political willpower behind doing any of that. Of course, I'm the optimist.
Yes, I think some comprehensive program probably will come down the road. Again, it's going to be a challenge to get there, I would agree. The only thing that I think looks to be fairly certain is that the payroll tax, which has been reduced by 2% the last few years, and it was extended again last year, I think that is going to end. that's probably the first thing they're going to agree upon, because no one's really supporting keeping that lower rate, and they want to put that back. So from what I've heard, at least, that's probably going to be a starting point, but that's just so small compared to the whole picture. We're going to have to do a whole lot more.
Considering that I was born in 1949, I was glad to hear Elliot say that the life expectancy is now up to 78.
All said in your presentations that the housing market will lead or at least be a part of our recovery. But I also saw that 42% of homeowners are underwater in their houses and 40% can't qualify because of tight credit. So can you comment on how the housing market will lead when 80% of the population can't either refinance and is stuck in high fixed mortgage or can't qualify for a mortgage?
Two things. First of all, those numbers, maybe I didn't explain it well enough, they're not mutually exclusive. Part of the 40% is also part of the 42%. So essentially, it's not that 80% can't qualify. But whatever the number is. The bottom line is that we came down so far. Permits in Phoenix literally peak to trough are down over 89%. To get a recovery doesn't take very much. To go from 6,800 units to 12,000 units is a huge percentage increase, but numerically it's small. To go from 12 this year to 14 or 15 next shouldn't be much of a trick either. So we're not saying it's going back to 63,000 units, which was the peak, or even 30,000 units in any foreseeable future, which is the long-term trend. We're just saying it's likely to pick up because the excess supply is being absorbed. And that will essentially force new construction. By the way, I don't think it's possible to have a sustained recovery without a strong housing sector.
Pretty much, yeah.
Guess you're stuck with that answer.
That's a good answer. I have a follow-up to that for the banker. So there are a few different programs out there now for homeowners who are underwater, and they are only for government-backed mortgages. Some people aren't in mortgages supported by Fannie Mae or Freddie Mac, and I'm wondering if there are any programs that you foresee coming out for those homeowners who are stuck in a high fixed mortgage, can't refinance because their loan value is 125%, 150% of their home's value. Do you have any idea if there's anything coming?
It's a good question. I mean, on the one hand, most of those mortgages are held by Fannie or Freddie, and I do think that this is not really answering your question yet, but I think that the last go-around where, I think is it Part 2 or HAMP 2, where the government began to waive the loan-to-value requirement in order to adjust the interest rates, which is a government program, should have been done earlier, but has been helpful. Our bank doesn't really hold very many mortgages, but for example, Wells Fargo, I know Garrett Hofstadter, who runs Arizona and several western states, and he told me that over the last 2 years, Wells Fargo has refinanced a couple of $1 billion worth of private note mortgages nationwide. So I think that there are efforts being made by big banks that hold mortgages to work with homeowners. But I understand it's a frustrating process, and it's one where whether it's the banking industry should have really borne all the blame that it has in the public eye, it's still part of public perception. And I know it's frustrating when you hear a lot of anecdotal stories. Well, everybody else is getting refinanced, and I've made all my payments, and I can't. And there's a lot of that. But at the end of the day, one of the things about the banking industry is, and I've thought about this a lot. We didn't sell any of those houses. Well, I guess we sell a few that we foreclosed on. But we didn't sell any of those houses, and we didn't pocket the difference. All we did was facilitate the transaction. During the housing bubble, this is another interesting thing. Probably, it's hard to know exactly, maybe some of the other gentlemen here would have the numbers exactly, but probably 85, maybe even 90% of the mortgages that were generated by the lending sector in 04, 05, 06 during the bubble were underwritten properly. You know, they weren't liar loans, and the people had the debt-to-income ratios that qualified. They simply paid too much for the house because of the frenzy that now, in retrospect, we all see. And as I said a few minutes ago, you know, the banker didn't sell that house. All the banker did was facilitate the transaction. And it would be a rhetorical question that everybody would know the answer to if I said, well, gee, you bought the house for $400,000, now it's only worth $3, you owe $320, you're frustrated. Go back and get the $80,000 back from the person that sold it to you for $400, and we all realize that that's not economically possible. But what's happened is that the banking industry has ended up being the poster child for, you know, the fault for facilitating that transaction, and now you hold it and it's underwater. The banks have suffered huge losses on their balance sheets for holding underwater mortgages. So there are a lot of complexities that go into further writing down a mortgage that you are holding that would take way too long to answer. But at any rate, as I said before, I know that Wells Fargo, and I'm sure some of the other big major money center banks that hold lots of mortgages have worked with underwater borrowers, but it's a complex problem.
Any other questions?
Okay, first of all, thank you for your time, and thank you for inviting us, students at the FCB, to take part in this. As a student entering into a tough job market, some of us with high debt levels, what advice can you give to us to help us with our success?
Work hard. And work down that debt first.
Yeah, I'll also tell you, I have a daughter who just got her MBA, and the tenacity with which she had to look for a job was something that I think is foreign to either of us, or all four of us on the panel. I had one job interview my entire life, okay? And in essence, the amount of effort she put into it from the beginning of the second year of her MBA on was amazing. You have to be tenacious, you have to present well, you have to have a thick skin, and you have to just keep on trucking until it happens. There are jobs out there, you're well qualified, keep on trucking, don't get discouraged, use every contact you have. That's what helped her. Dean, do you want to talk about that?
I was going to say major in finance or economics. That's
Sorry about that.
No, it is a tough job market, but we're seeing students getting jobs. But I think we heard the 5 Ps, and you could work pretty hard on those, and that will help you get a job. But we also have a really good career development office. If you haven't been there, you should go.
Thank you.
Any other questions? Oh, well, thanks to all of our panelists and to Mr. Sarver for sharing their insights today. And thanks to all of you for coming out.